welcome to Money's Best Friend with me, Vivek Law. The biggest misconception most of us have is that we need to be rich in order to make investments. But investments are merely tools to actually help you build wealth. It's not a privilege of the wealthy alone. So how can you build this wealth? How can you ensure a definitive corpus for your child's education and marriage, your own retirement, or your first house? What are the investment avenues best suited for you? On this edition of Money's Best Friend, we take you through the do's and don'ts of investing your money in 2016. To discuss more on where and how you can invest in 2016, joining me is Lovai Navlakhi, Certified Financial Planner, one of India's finest experts on the subject. Thank you very much, Lovai. You've come from Bengaluru all the way here, so thank you very much for joining us here on Money's Best Friend. It's that time of the year when probably the biggest talking point is about tax planning, right? Because at least those who are employees are now suddenly waking up to realize that they haven't submitted their investment proofs and the companies may actually cut tax. Of course, you can claim that later, but it's still a tedious process. So let me start with a question I've often asked you. Tax planning versus financial planning. Are these integrated? Because most of us tend to go out and buy products to save tax. And that is where I think we all make a big mistake.
Yeah, absolutely. Of course, they are integrated. So tax planning is a part of financial planning and it should be treated that way and not the other way around. I think it's very important to look at any investment decision that you make based on what is the returns that you're getting, what is the liquidity that it has, and the risk that you take. And when you're comparing returns, the important thing is to look at what is the return after tax. I think people tend to just look at the saving that you make on the investment and make a decision. I think what you have to see is what is the return I'm making on that investment, keeping in mind the tax break that I get. So that is, I think, important. The other thing is that when you're doing tax planning as a salaried employee, you know this at the beginning of the year that this is my income, this is what I need to do to save or invest in a certain manner so I can save tax. So one of the investment options that you will have is in equity. Other investment option you could have is something in the fixed income space. So it could be your PPF account or so on. But I think that it's important for you to know that if I'm going to invest in equity, then the simple and the most effective way to reduce the risk in equity is to stagger that investment. When you wake up in January or February and say, yes, I can invest to save tax, and based on your risk profile, you choose an equity product, you are taking risk for yourself. Yes, it's a 3-year product, it's locked in, etc. But you are taking risk. And there are simpler ways of saving tax and reducing the risk. And I don't know why people don't do it.
But what also happens is, Lovai, that this is the time of the year when we start getting bombarded with phone calls, isn't it? With people trying to sell us products. And many of us, are so focused on saving that tax that we just go and lap them up, right. Especially insurance products, isn't it? Yeah, absolutely. And I think that the simple way, like I said, if I had started my actions in April already, in the beginning of the year, when I get these calls, and I get many of these calls at this time of the year, I can just say, I don't need this, I've already done my tax planning. It's plain simple. But when I have not done it, then this sort of noise becomes louder and louder in my ear, and then finally I succumb and say, okay, who is the most persistent? Who is the one who's calling me at the right time? Or tomorrow morning I have to submit a proof. Who's going to give it to me today? And obviously, when you take decisions impulsively, they are not necessarily going to be right. And I'm not saying they may be wrong. They may be right. It may be just perfect. The day you decide to invest, that's the best day. But I don't think that's the right way to do it. And I think people forget that when you look at the words tax planning, there is a very important component which is planning. And you're focusing only on the tax saving and not on the tax planning. If you planned it, you'd probably do a much better job of selecting the right instrument and at the right time. We're going to keep our chat going, but there are lots of questions also for you, Lovai, from our viewers. So let's take some of them. Amrit Jyoti Mahanta from Assam is joining us on the line. Hi, Amrit.
Hi, hello.
Hi, good talking to you. How are you?
Yeah, nice. I am fine. How are you?
I'm good. And How is your money doing for you?
It's quite good.
Quite good. That's very
Yes.
nice to hear, Amrit. Very few people say it's quite good. Most of them want more and more or are unhappy with their money. So tell me, how can I help you?
Actually, I just want an advice on today.
Yes.
Actually, I'm 29 years old,
Mhm.
and I just want to invest in 3 to 5,000 per month in SIP
Okay.
in a mutual fund.
Mhm.
So I can take a little bit risk for this. So I am seeking for your advice. Which can I suggest some funds through which I can invest the money?
Okay. You wrote to me saying that you want to invest for a period of 3 years. Why 3 years?
Yes, yes.
Why 3 years?
Actually, I am not still yet. I am single, and some I can accumulate some money to my marriage and all these things. So the period is going for 3 years.
Okay. All right. I wish you could extend that, but I can't tell you to delay your marriage beyond 3 years since you want to. But let's listen into Lovai. Well, what he's got right is the fact that he has a goal.
Right.
That he is wanting to invest because he sees himself getting married. I'm not so sure 3 years is enough to get the best out of equity. But what would you advise him?
Yeah, so I'll go the other way around and say, let's look at 3 years from today. He needs the money. Let's for a minute assume that because he's young and he wants to do on a monthly basis, we can take risk and put it into equity. What I would do is probably 12 months before the date, so that is 2 years from today, I would start reducing my equity exposure. So that I'm not taking risks as I approach my marriage date. I'm not dependent on, the market went down in the last 6 months or 8 months of the year. And I've sort of lost my money and I'm not able to meet my goal. Now, if I was to do that, and if I'm going to do an SIP, what it means that actually I can do an SIP for 1 year, because the 12th month installment will be 1 year old in 24 months from today, and then I have to start cutting down my exposure. So logically, what will happen in his case is that I can put into equity for a year. And after that, because my debt investments anyway have a 3-year sort of tax limit for making it long term, I might have to put into debt products a larger portion of that SIP, maybe into a dividend option or so that I'm not going to pay a high capital gains tax. And that's the way I would plan it. So it may not allow for a huge corpus growth, but I think it's more focused because it's goal oriented and I don't want to have that risk that I'll lose some money.
So for the kind of money that he's intending to put away every month, what would you recommend? How many schemes? Which schemes?
So it's 3 to 5,000 rupees. I would think couple of schemes are more than enough because he has a short period of time to try and accumulate the money. Maybe one scheme with a little bit of risk. While he's saying I'm willing to take risk, I think I would take only one of the schemes with risk and one which is relatively safer. So take a large cap diversified equity scheme and then take one mid cap equity scheme for the first 12 months. And assuming that the budget doesn't change anything about equity taxation, then we sort of relook at this a year down the line as to what he needs to do going forward.
All right, Amrit, I hope that is of help to you. Wish you all the very best for the next 3 years. We also have an email which has come in from VKV Raman from Hyderabad. He writes, I'm a senior citizen. I'm 63 years old and I'm retired. I'm not working now. Please suggest how to make the best use of my retirement corpus of around 50 lakh rupees to get a monthly return of 50,000 post-tax.
So that 6 lakh rupees a year on 50 lakh is 12% after tax. Very high risk required for me to get that type of return, and I don't know at 63 whether he wants to take that. Number one is what is his cash flow requirement apart from that 50,000 rupees a month. What does he want to do with the corpus itself? Is it okay if it depletes over 15-20 years? I think those questions need to be answered. Once you look at the risk profile, I have to find what are the avenues. So there are tax-free bonds available which will give you tax-free return, and that's 7.5% only. So it won't meet his sort of criteria, but it's giving him some sort of regular cash flow on which he is not paying tax. There'll be some amount that he needs to put aside which is protecting inflation, so has to be equity linked. So in fact, some part of his portfolio may actually be invested in a place where he's not getting regular monthly return, which putting even more pressure to get that amount that he's looking for. So I think he needs to relook at what is that amount, that 50,000 rupees per month tax free. Is that an essential thing, or is it he wants 6 lakhs per annum tax free and he wants 25,000 or 30,000 per month and then a lump sum at the year end? I think your investment decisions will vary based on that. I think very often people, when they meet an advisor, they tend to go towards the ultra conservative side because they'd much rather prefer a lot of money in their hand so that they can decide what to do with that money. And if they're not going to use that money, so they do two things. One is a larger return and a much shorter time frame. Both of these sort of ensure that your returns sort of drop and you're then going to sit with idle money. So I think that part needs to be done accurately and then look at this. But I think one thing he must know, that this is a very ambitious target of trying to get 50,000 rupees a month tax free on a 50 lakh corpus. That's the tough part.
On another note, Lovai, it's interesting because we are increasingly also getting mails and queries from people who are above 60.
Right.
There has been this other misconception, which is that the minute you're retired, equity is a strict no-no for you. And I use the word misconception because given life expectancy, the way it's going up, you still probably have to live a good 20 to 25 years after your retirement. And of course, you can't be invested in equity to the extent you were when you were 25 or 30. But to also go the other extreme and say it's a strict no-no may not necessarily be the right thing.
Yeah, absolutely. I think what happens is that if you were able to rightly calculate what is it that I wanted on a monthly basis, I protected that, number one. Then I said, okay, in the next 2-3 years, what are my needs and requirements? I protected that. That is, I don't have equity exposure at all for these requirements. Beyond, say, 3 years needs, then I sort of look at my risk profile and say, okay, can I put 20%, 30%, maybe even 50% of my money in equity, so that that money will grow over a period of time, will help me beat inflation for sure over a long period of time. Because there have been years, as you've seen in the last 3-4 years, where returns on fixed income products have been below your rate of inflation and you've actually lost money. And that's not a good sign for somebody who's just retired and is looking at the next 30 years to make sure that the money doesn't deplete, but the value of the money is depleting. And I think that's a very, very critical factor to take into account.
All right, let's take a quick break here on Money's Best Friend. We will take more of your queries with Lovai Navlakhi here in the studio. It's time now to take some more of your questions. Joining me is Rachel from Bangalore. Hi, Rachel.
Hi, so my question is, basically my husband and I at the moment have a surplus of about 30,000 rupees each month. And this is our first venture into SIP. So we're just looking for some guidance as to what sort of portfolio we should create for ourselves. And this is apart from the education and the mortgage. And this is a surplus beyond that.
Okay. And how much money do you have right now to spare?
About 30,000 rupees each month.
And you haven't yet started investing?
No.
Okay. All right. And you're looking at a 10-year kind of a time frame?
Yes, that's right.
Okay. What would your advice be to her? Very sorted, both of them. They have a surplus. It's a decent surplus at this age. And they're very clear that it's a 10-year investment.
Right. I heard her say that, this is net of mortgage and education requirement. And I mean, that is something that maybe we should look at a separate point in time, that what are they doing really for education.
In fact, we can ask her right now.
Yeah.
So Rachel, can you add to that bit in terms of what have you done as far as the education piece is concerned?
No, actually at the moment we've just been married recently.
Right.
So the children fund is not something we're looking at the moment.
Right.
But from a mortgage point of view, the house is sorted.
Okay.
So we're done with the mortgage already.
Okay. All right.
Okay.
So both of us have been working abroad for a couple of years. So we've just come down to India as well.
All right. Great.
Okay. So I think if you have a 10-year time horizon with the investment, it's a good way to start in equities. And I don't know, the first thing probably that you need to do is a sort of a risk profile to understand what's the quantum of risk that I can take. I think people also do the other mistake. While yes, you said people over 60 don't invest in equity, the younger people assume that whatever I am saving, all that money needs to go to equity. It may not be the required, it may not suit them from a personality point of view. But assuming that this is 10 years and therefore this is for capital appreciation and therefore you're looking at risks sort of to invest, my thought would be to break this amount up into, and if it's all equity, maybe couple of large cap equity funds, a couple of mid cap or multi cap funds, and one balance fund to sort of take care of this. One important thing is that at 29 and they just married, come to India, they are saving 30,000 per month. Chances are that in the next couple of years, the amount that they can put aside may actually go up till they have a child. And then therefore the idea of having these 4-5 different instruments is that they can add on to those and then not start creating something new at that point in time.
Are there any particular schemes you like in some of these categories you talked about?
Yeah, so I would say that in the large cap space, maybe an ICICI focused blue chip, Mere India Opportunities Fund are two good options. In the mid cap space, maybe a Motilal Oswal mid cap 30 is there. Then there's a multi cap fund of Franklin India Flexi Cap. And then in the hybrid category, an HDFC balanced fund would give them sort of a nice exposure across different fund houses and across different categories.
All right, here's another email that has come in for you, Lavai. This is from Pradyuman Rao from Mumbai. He writes, I am 27 years old. My annual income is approximately 10 lakh rupees. I have already invested in 3 mutual funds with 2,000 rupees SIP per month each. I also have 2 insurance policies of 2,000 rupee and 750 rupees per month for a period of 20 years. I wanted to increase my investment in mutual funds by another 4,000 per month. Should I increase my investment in the funds already invested in, or should I change my investment portfolio?
So I think from the schemes that he's mentioned, there are 3 schemes he mentioned: HDFC Mid Cap Opportunity, Franklin India Smaller Cap Smaller Companies, and ICICI Blue Chip Fund. They all have a long-term track record, good track record. The HDFC Mid-Cap Opportunities is one fund which has become fairly large in size and maybe needs to look at whether there is an alternative fund that he can invest in. The other 2 schemes are pretty good and he can continue investing in them. And I think that maybe the amount that he's talking about, 4,000, he can add more to the Franklin Smaller Companies and the ICICI Focus Blue Chip, and then add a balance fund to it. So 1,000 rupees each in these 2 schemes and 2,000 rupees into a balance fund, HDFC Balance or L&T Prudence. Those are options.
It's heartening to see, isn't it, that we are getting increasingly more and more people who are starting younger and who are willing to actually invest with a clear goal in mind.
Right.
And which was sometimes we found lacking in people, that it was more about buying a product or looking at short term rather than actually setting yourself a goal and then working towards it.
Yeah, absolutely. I think few years ago, long term you would be 3 months.
Yes, exactly.
Very often.
Maybe lesser.
Yeah, and I think that's really a heartening change. And possibly I think media has played a big role in this, of educating people and making them aware. And I think these younger people have experienced, maybe friends or people who are 5-10 years older who have experienced different things. Because if earlier, I think what was happening is that the younger people relied on their parents who were from a different generation and used to saying put money in banks or any tax effective or tax saving instruments that the government of India used to do in the in the 20 years ago. And therefore they didn't have exposure to other things and the kids didn't know anyone else better to go to. Now I think people know people 5 years senior, 10 years senior who've experienced and had success, I would say, in making investment through an SIP route, at least to start with. And the awareness of mutual funds has increased. Of course, the quantum of penetration, etc., is still very, very low. But I think that's a heartening change, and it's so much easier for us advisors when we are talking to people. Yeah, they are aware of mutual funds. Otherwise, we have to start with what is a mutual fund.
One of the big changes we've seen, Lovai, is in the last 2 years we've seen a lot of SIPs having been opened. We've seen large amount of retail inflows. Of course, it's still very small compared to the potential, but these are record flows from retail investors in the last 2 years.
Yeah.
But we've started this year not on a very good note. There are global issues staring us in the face. Most experts say we're going to have fairly volatile times in the next few months due to global factors. What happens typically when you see this kind of volatility or a sustained fall? You tend to get disheartened, you tend to get distracted. What would your advice be to people?
So I would tell people that, you can just go back and look at 2008. And those of you who had an experience of doing SIP during 2008 when the global crisis came in and markets kept falling and you continued doing SIP, sometimes because you were not aware, you forgot about it, I think more often, that was a good thing. And then you looked at it in 2009 or 10 and it looked fantastic because you kept investing when the markets fell. And then you got a fantastic return when there was just even a minor uptake, you got great returns. So I think that's important. If you're keeping on looking at the shorter term history, just look at a little longer term history. It'll probably give you some answers. And the idea of getting into an SIP was, I presume, was that, I have a certain amount of money which I save every month. It'll remain idle in the bank. Let me just make sure automatically it gets swiped out and goes into an investment. And the idea was that I'll not look at this for 3 years, 5 years, or hopefully even longer. And if that was your objective, I don't think anything has changed. Yes, it probably you'll go through a sort of grinding time. You have gone through in the last 12 months. It looks like you've gone through in the first fortnight of 2016 as well. And maybe you'll go on for another quarter. But then the results will start showing. And they are quite dramatic when you look at your statements. And I've seen that happening for clients in 2008 and 9. And you kept looking at them and looking at a red sign, and suddenly when you see black, it's a significantly up black, and you feel, wow, all my efforts sort of paid off. So that's my advice to people who are trying to worry about SIPs. Really no need to worry.
Thanks very much, Lovaie, for coming by. It's always a pleasure talking to you. Thank you for taking questions of our viewers. It's time to wrap up this edition of Money's Best Friend. If you have any queries related to equity, mutual funds, insurance, real estate, gold, then do write into us at moneysbestfriend@aajtak.com. Have a lovely weekend.